For decades, the global financial system operated on a delicate but powerful promise: stability. Markets could rise or fall, economies could boom or recede, but at the center of it all stood trusted institutions, predictable central banks, and safe government bonds. It was a dance that investors, governments, and everyday people learned to follow. Interest rates were low, credit was easy, and growth, however slow, was consistent. But, like all illusions, this one could only last so long. In 2024, the cracks beneath that surface began to widen. Rising interest rates, fiscal gridlock in major economies, and global inflation turned the promise of predictability into a global reckoning. The safe assets became volatile, the currencies wavered. And one by one, the pillars of modern finance started to shake. This wasn't a crisis sparked by a single event. There was no war declaration, no pandemic, no collapse of a major bank. Instead, it was a gradual implosion of trust, a creeping awareness that the rules had changed and no one had received the memo. This story isn't just about markets, it's about a shift in power, perception, and the systems we rely on to define value. As traditional assets trembled, alternatives like Bitcoin surged. As central banks hesitated, retail traders charged it in. As emerging economies collapsed under debt, new financial ecosystems quietly rose from the ruins. It began like a tremor, small, overlooked, even dismissed. But when the US 30-year Treasury yield surged past 5%, the aftershocks rippled across the planet. What had long been considered the most stable, risk-free investment in the world was now acting like a volatile stock. For a generation of investors raised on the idea that US debt is safe, the message was clear. The rules had changed. Behind the scenes, the forces were building for years: mounting national debt, gridlock in Washington, inflation that lingered far beyond forecasts. The bond market finally reached a breaking point. Prices plummeted, yields soared, and the global cost of money shot upward in lockstep. Suddenly, corporations faced higher borrowing costs. Mortgages became unaffordable for millions. Developing countries struggled to service dollar-denominated debt. And portfolios built around the idea of stable bond returns were obliterated almost overnight. It wasn't just a financial story, it was a psychological shift. If even US bonds could shake, what was left to trust? Investors began to flee traditional safe havens, not out of greed, but out of fear. They weren't chasing higher returns, they were searching for solid ground. In that search, the financial world turned its eyes to the unlikeliest of places. As the financial system wavered, investors searched for refuge and found it in Bitcoin. Once dismissed as a speculative toy, it shattered expectations, rising past $110,000 and capturing the attention of institutional giants, hedge funds, and even retirement strategists. Why? Because when faith in fiat currencies erodes and inflation runs wild, people turn to what can't be printed, paused, or politically manipulated. Bitcoin offered something no central bank could: sovereignty. It wasn't stable, but that was the point. In a collapsing order, volatility became a sign of life. This wasn't just investment, it was rebellion. A digital exodus from the old rules, fueled by distrust and the dream of financial freedom. Japan's slumber ended with a tremor that echoed worldwide. After decades of near-zero interest rates, its 30-year bond yield climbed to 3.17%, a level not seen in over 25 years. Investors around the globe were stunned. The world's most conservative capital suddenly had reason to stay home, pulling billions from US and European markets. That silent shift broke long-standing assumptions. If Japanese institutions no longer needed to chase risk abroad, who would finance Western debt? Currencies wobbled. Bonds cracked. Central bankers scrambled. Japan, long a background player, had become a force capable of rewriting global capital flows. The quiet giant had awakened, and the rest of the world had to adjust. The financial world faced a rude awakening. What was once considered safe now felt fragile. As interest rates rose, everything changed. Mortgages grew more expensive, startups stalled, and risk assets began to bleed. Bonds, tech stocks, real estate all came under review. Investors started asking new questions. What is real value? What's worth the risk? Capital began retreating from emerging markets and speculative plays. Venture funding collapsed. IPO dreams froze. But this wasn't collapse. It was transformation, a behavioral reset. Markets weren't correcting, they were evolving. The world wasn't ending, it was recalibrating. Those who failed to adapt weren't just left behind. They were erased from the map. Central banks, once hailed as market stabilizers, now stood at the center of the storm. The Fed raised rates to fight inflation, but risked stalling growth. The ECB hesitated, fearing debt crises in Europe. Meanwhile, Japan toyed with ending its ultra-loose policy. Trapped between inflation and recession, they faced impossible choices. Each move they made sent shockwaves across the globe. Their credibility, once unquestioned, now hung in the balance as trust eroded and markets turned restless. For years, the world's largest corporations thrived in a climate of cheap money. Tech giants borrowed billions to fund innovation. Real estate empires expanded with low-interest debt. Even legacy industries relied on favorable credit conditions to sustain growth. But when interest rates soared and yields climbed, that era of easy expansion came crashing down. Suddenly, debt wasn't just a tool, it was a threat. Companies with massive loan obligations faced ballooning interest payments. Margins shrank. Share buybacks slowed. Even titans like Apple and Amazon felt the pinch, seeing market caps wobble and forecasts revised downward. For startups and scale-ups, it was worse. Funding dried up almost overnight. Venture capital, once abundant, became cautious, even cold. The result? A wave of layoffs, cost-cutting, and strategic overhauls. CEOs took to investor calls with trembling confidence, trying to mask fear with optimism. "We're adapting," they said. "We're resilient," but the market was unforgiving. Stock prices tumbled at the mere hint of slowing growth. The old model, borrow big, grow fast, no longer worked. Now, cash was king again. Only companies with strong balance sheets, minimal debt, and flexible business models could weather the storm. It was a brutal filter, and many household names found themselves fighting for survival. As Wall Street watched with clenched jaws, one truth became painfully clear. In this new age of volatility, even giants could fall. As bond yields surged and markets spun, another silent battle unfolded. In the shadows of currency exchanges, it wasn't just dollars and euros anymore. It was a high-stakes tug-of-war between nations, where currency strength became a weapon and volatility the new battleground. The US dollar, bolstered by rising Treasury yields, grew stronger. At first glance, that seemed like a sign of strength, but it came with consequences. A stronger dollar made American exports pricier and hit multinational companies in the wallet. Countries with dollar-denominated debt, especially in emerging markets, watched in horror as repayment costs exploded. What was once manageable became a financial chokehold. Meanwhile, the euro struggled under the weight of recession fears and energy insecurity. The Japanese yen weakened, even as yields rose, a contradiction that baffled traders and raised the cost of imports. China's yuan, tightly controlled but under immense global pressure, wavered as Beijing tried to stabilize growth and avoid capital flight. In the midst of this chaos, central banks quietly intervened. Some sold dollars to defend their local currencies. Others raised rates not for inflation, but simply to stop currency collapse. It was like a dance, where every move changed the music, and every nation stepped on someone else's toes. For investors, forex markets, once a specialized arena, became a front line of strategy. Traders flocked to safe havens like the Swiss franc or gold-linked assets. Others bet against vulnerable economies, shorting currencies with weak fundamentals. But this wasn't just about money. Currency wars reshaped geopolitics. They influence trade deals, shift alliances, and ignite tensions. In a world already fractured by inflation, conflict, and instability, the currency battlefield added another layer of complexity to an already perilous landscape. As institutions wavered and experts hesitated, a new force surged from the digital trenches. The retail investors no longer sidelined. This army of everyday people, armed with smartphones, apps, and a hunger for opportunity, began reshaping the markets. It started subtly, but soon became impossible to ignore. Reddit threads turned into trading hubs. TikTokers analyzed charts. Discord servers became war rooms. Platforms like Robinhood, eToro, and Binance gave global access to markets that had once been guarded by suits and silence. Now, a 19-year-old from Sao Paulo could move the needle on a penny stock or swing crypto prices overnight. fueled by frustration, FOMO, and often a touch of rebellion. These traders weren't just chasing gains, they were challenging the old guard. GameStop, AMC, Dogecoin, these weren't just investments, they were battle flags. And while critics called it chaos, there was brilliance in the swarm. Retail investors learned fast, they collaborated, they shared strategies in real time. They moved like schools of fish, overwhelming even billion-dollar hedge funds. Some called it a bubble, others called it revolution. In the era of global volatility, trust in institutions faded. But this new generation trusted each other, or at least, trusted the movement. Still, the risks were real. Many lost fortunes just as fast as they made them. Algorithms outpaced human instincts, scams multiplied, and market volatility became a roller coaster few could handle long-term. But even in loss, the retail army grew stronger, wiser, more determined. This wasn't just a moment, it was a shift in power. While headlines spotlighted Wall Street and Tokyo, another story unfolded. Quieter, but just as critical. Emerging markets, once the darlings of global growth, were now caught in the shadows of soaring U.S. yields and global uncertainty. And the fallout was severe. These economies, from Argentina to Turkey, South Africa to Vietnam, had thrived on cheap global credit and investor appetite for high returns. But when U.S. bonds became attractive again, capital began to flee. Fast, currencies depreciated, inflation soared, debt, often dollar-denominated, became unbearable. For many, this wasn't the first crisis, but it may have been the most complex. Food and fuel prices, already volatile from war and supply chain shocks, pushed millions closer to poverty. Governments were forced into painful decisions: raise interest rates and risk recession, or print money and face runaway inflation. Neither option offered salvation. And then there was the political toll. In some nations, protests erupted. Citizens watching their savings evaporate and costs skyrocket took to the streets. In others, leaders clung to power with desperation, blaming outside forces or manipulating currencies to delay the inevitable. The IMF's phone rang off the hook as nations begged for restructuring, bailouts, or breathing room. Yet amid the struggle, hope flickered. Countries like India and Indonesia leaned into domestic innovation and digital infrastructure. Kenya and Nigeria saw fintech surges creating new paths for inclusive growth. Brazil's natural resources became a bargaining chip in a resource-hungry world. These weren't solutions, but they were signs of resilience. Emerging markets weren't collapsing, they were evolving under pressure. But make no mistake, in a volatile world, they bore the heaviest burden. And how they rose or fell would shape the global balance for years to come. The global financial system, once a symbol of order, now felt like a fortress cracking at the edges. Trust was eroding. In bonds, banks, even governments. Institutions that shaped the post-war economy now faced a new reality: fragmentation. Nations turned inward, alliances weakened. Markets reacted to headlines, not fundamentals. It was no longer just volatility, it was systemic fragility. The question wasn't when the chaos would end, but what would rise from its ruins. Out of every collapse, something new emerges. The storm of global market volatility has shaken faith, broken patterns, and exposed weakness. But it also sparked innovation, resilience, and a reimagining of finance. New currencies, new voices, new strategies. The world won't return to what it was. But in the ashes of the old system, a new one is forming, faster, smarter, and maybe fairer. For those who adapt, this isn't an end, it's a beginning.